Okay, so hello everyone. I'd like to welcome you to this edition of the IJW COVID series of webinars. This edition is COVID and the international M&A landscape. And I'll be your moderator for the session. My name is Drew Dorweiler. I'm a managing director with IJW & Co. IJW, we're a boutique investment bank headquartered in Montreal and specializing in M&A transaction advisory, business valuation, and corporate finance on a global basis through our offices, not just in Montreal, but Toronto, Hong Kong, Singapore, and Antigua. And speaking of global basis, we are extremely privileged to have live on this webinar a not just distinguished, but global array of panelists. Our first panelist, Dan Skyte, an associate with Hanover Investors in London, UK. Our next panelist, Rajeev Dewan, who is a partner at McMillan, a Toronto-based law firm, and as Raj will be mentioning, very active in Asia and India. And finally, speaking of Asia, Padraig Walsh, a partner at the law firm Tanner DeWitt, headquartered in Hong Kong. And with that, I'll allow each of the panelists, please, to give a more robust introduction of themselves and their backgrounds. So first, Dan, please.
Hi guys, and hi to you, Drew. Thanks for inviting me onto this panel. Looking forward to the discussion. So I'm an associate with Hanover Investors. So we're a UK-based private equity fund, and we invest across Northern Europe, so primarily the UK and the Nordics. And we're slightly different from most PE funds. So most of the businesses that we invest in are listed on public market. So we typically invest through public to private transactions, or sometimes we keep businesses that we invest in public. My job is to help our portfolio to grow through M&A, and so typically that involves cross-border transactions, which is why I'm kind of keen to get into the conversation today. I also help us look at the private markets in the UK.
Okay, thank you, Dan. And Raj.
Thanks, Drew, and thanks for organizing this seminar. My name's Raj. I'm a partner in the capital markets and M&A practice at McMillan. We're a national business law firm. I'm also active in our China practice. We're actually the only Canadian law firm with an office in Hong Kong. My practice is largely transactional. I work with a number of small mid-cap public companies or emerging growth companies that are going public in the Canadian markets, and we're also actively involved through our Hong Kong office on cross-border transactions and M&A between Canada and Asia, with the principal focus on Southeast Asia, including Singapore, Hong Kong, and mainland China.
Okay, excellent. And Padraig.
Thanks, Drew. Hi, all. My name is Padraig Walsh. I'm a partner in the corporate commercial team in Tanner DeWitt. Tanner DeWitt is one of the largest independent law firms in Hong Kong, and within the corporate commercial practice, I primarily focus on venture capital and mergers and acquisitions, and cover the technology sector generally in terms of the area of industry that most of my work is.
Okay, thank you. So as you can see, we have some very distinguished panelists. Really looking forward to the remainder of this hour. And just digging into the first question, I'll open to the panelists, is if just more of a general nature, in each of your respective areas of practice, what are you seeing in the M&A market in light of COVID-19? And I'll start with, I'll let Raj kick things off, please.
Thanks, Drew. So, I mean, I think what we're seeing is after a period of record number of M&A and in and outbound transactions, certainly in North America, we're seeing a number of deals being put on hold, delayed or canceled, and parties, buyers and sellers, are trying to assess what the new landscape is as a result of the current volatility. I think we're seeing a number of discussions revolve around valuation and financing issues. In particular, I think there's a heightened uncertainty in the market about what the impact of COVID-19 may have on business models of companies kind of going forward. And I think on that basis, it's probably fair to say that we've kind of switched from a seller's market to one which favors buyers, especially those with fairly strong capital positions and balance sheets, and who have the ability to deploy capital in a strategic and in an opportunistic fashion, given some of the valuations that we're seeing. In terms of the capital markets, we're seeing a much more cautious approach to raising capital in the equity capital markets. I think there are certain sectors that have achieved some momentum in raising capital. I think mining is one of them. Life sciences and healthcare has been another sector, perhaps on the back of the COVID-19, and there's a heightened awareness about the importance of investing in healthcare and life sciences. And I would say finally, certainly in North America, we expect some M&A and consolidation in the cannabis sector, which has until recently had a very strong run in the equity markets. And so we would expect some consolidation amongst players, in particular where there's the right deal strategy with those who have licenses in key markets.
Okay, perfect. Thanks, Raj. Padriag, your thoughts, please.
Well, what we're seeing here is first, the major impact is that deals that have been in progress and in play, well, the progress involved has slowed up. Those deals haven't stopped. It's just by necessity, the decision-making that goes into creating and maintaining a deal momentum. That kind of momentum has just lost a bit of traction because of the logistical difficulties in having the right people making decisions in the right places at the right time. We are seeing that none of the deals that we've been handling within our corporate commercial team have been pulled or have been cancelled, but the progress of them has been delayed. We are still seeing inquiries and the early stages in respect of deal activity continuing on. But you can see that there's a lot of uncertainty, particularly around how you would value the assets in question. But there are clients who see opportunity in this market, and that opportunity is going to derive from the fact that assets are at a lower valuation. And if people are, if the growth of certain business sectors is based on growing by acquisition, now is a good time to do so if they have the means to do so. We're also seeing some inquiries that are around maybe more novel approaches to trying to get deals across the line. Things like making more of a use around the target's assets as a means of achieving finance to get the deal across the line. And some inquiries that have also been around management buyouts on the basis that you had investors involved who are looking to exit and manage a management team that was still interested and anxious to push the business forward after, hopefully with light at the end of the tunnel after COVID-19 is properly dealt with.
Okay. Thanks very much, Podrick. And Dan, from your buy-side perspective as well as your European perspective, kindly give us your thoughts.
Yeah, I mean, I think I'd echo the other guys. So I think I would agree that by and large, the deals that were launched pre-COVID kind of ticking along, progress definitely slowing. But if you look at the cohort of deals across the market right now, I would say 95% of those deals were launched pre-COVID. And at least in the UK, we're seeing practically zero or very few new processes coming to market. And I'd be interested to hear the IJW perspective. But I mean, I guess the key point is, why would you launch a process now if there isn't any kind of need to sell? So from a buy side perspective, debt markets are tight. It's difficult to raise debt for new transactions, which obviously impacts valuation, and just the sheer range of outcomes that you have to think through when you're considering buying a company at the moment. You know, it's just so broad that the only kind of rational thing to do as a buyer in that perspective is to discount the price. So, you know, if you're a seller, if you have no kind of need and you have no time-based motivation to sell, it just is not necessarily, a good time to do so. So I think, normally in this situation, you might see some proportion of that lost deal volume being replaced by the kind of, need to sell type category. So companies that urgently need to raise finance based on, liquidity or balance sheet conditions. And I think at least what we're seeing at the moment is that hasn't happened yet. So we're not seeing a wave of deals come to the market where there is an immediate need to raise capital. And I don't know if that's due to government stimulus and loans being available, kind of low to no cost of capital. But so I mean, from a UK perspective, we're seeing deal flow fall dramatically. That primarily on the platform side, so new deals and thinking about, I guess, typical leveraged private equity transactions. I would agree with Podrick that on the corporate M&A side, there's still activity there. We're certainly very acquisitive, actually on both sides of business, which I'll come on to, but particularly on the portfolio size, because like you say, it's it can be an opportunity to pick up companies that you've been tracking for a while, where you already have relationships built with the target management teams, and for whatever reason they've just decided that they don't want to kind of bed in and go through another business cycle. So I think broadly speaking, private equity transactions definitely decline significantly, and new assets are not really coming to market, but you're still seeing some activity on the corporate side.
Okay. Thanks very much for your perspective, Dan. And next question is for the two lawyers on our panel. Namely, from a legal perspective, I'd love to hear what you have been seeing or hearing in terms of deals going through diligence. Raj, we'll start with you.
Yeah, thanks, Drew. I think kind of as a starting point for due diligence, conducting meaningful due diligence prior to signing any kind of definitive transaction documentation is going to become much more difficult and time consuming during this pandemic, given restrictions on travel and social distancing. I think even in terms of the format of investigations that are going to happen, it's going to be a little bit more problematic, or it's going to impact timing for transactions. And I can give you an example. We're recently involved on a mining M&A deal where, typically you would have technical geological advisors who would go and do a site visit. And unfortunately, in this current environment, they just can't do that. I think the other area where we've been advising clients where they're going to impact some delays is going to be in connection with investigations that require third-party consents or approvals. So given some of the lockdown, you're seeing it with various governments or government agencies. To the extent that you need approvals from, competition bureaus or other regulatory agencies, the timelines may be protracted. In terms of substantive due diligence issues, kind of what we've been advising our clients who are looking at acquisitions, I think they're going to be focused much more on understanding kind of what potential liability could arise to a seller in the context of either supply chain or workforce disruptions, which are very prevalent given COVID-19. I think they're going to want to try to understand the insurance policies, if any, which these targets have in place, and the extent to which there may or may not be coverage for losses, business interruption coverage. And we've seen some litigation already in Canada where restaurants have commenced class actions against various insurers in connection with that. I think, there's going to be a heightened focus on material contracts and understanding the impact and potential termination rights of counterparties in light of the pandemic. We're seeing parties draft agreements which are, including now specific termination language for COVID-19 pandemic. So it gives a broader range of termination rights to, in a context of a financing, we're seeing that. So those are initial thoughts on due diligence.
Okay. Thanks so much, Padraig. Raj and Padriag, your thoughts, please.
Well, maybe just to round out on some of the other points that we can just, we are experiencing, can see as being issues arising in due diligence. On the labor and employment side, while quite a lot of people have either been placed on unpaid leave or made redundant, often at relatively short notice, and maybe in circumstances where not all the I's were dotted and the T's crossed, and there's liability that arises from that. You can imagine that there are health and safety issues that also arise in terms of whether people have been compliant with government guidelines on how to deal with COVID-19, and you can see that there may be a risk of claims or litigation that might arise from that in the future. If you're looking at the contractual arrangements, you can also, I mean, your typical frame of reference in most contract due diligence is simply well, I wouldn't say simply, but we'll certainly focus on change of control issues and whether consents are needed for that. That's become a much broader issue now, certainly around termination rights, also about the impact of force majeure clauses, and whether or not contracts that are already in place, whether they would be renewed on the same terms, or whether there are other factors that just might affect contracts that are in place that sustain the business. You can see that there would be issues in the sector that I deal with mostly, in the technology sector, around increased data management and cybersecurity risks, and how those have been addressed and dealt with in situations where there's a much more distributed workforce. And also there are IT teams that are equally distributed and probably away from their home base and able to manage the risks that are inherent in managing a technology or data-driven business. And you can expect also a greater degree of diligence and care about the financial due diligence that will be involved, particularly on if there is lending or loan finance that's in place in order to provide financing into the business, and whether the covenants in those arrangements have been met, or whether there are covenant breaches that need to be addressed because of the recent turmoil in how the economy has suffered. So the due diligence is certainly a much more complex and difficult process to get through. But in a sense, that just feeds through into the valuation issues, which is if you know that there are increased issues within a business, it's either going to go two ways. You either walk away from the deal or you work on the price.
Okay. No, that's makes a lot of sense, Padrick. Thanks. And Dan, turning to you, being on the buy side of the equation, one of the elements of financing that's driving M&A activity traditionally is the access to the credit markets. And be curious to learn your perspective. How are you seeing credit markets behaving right now? Is there a general appetite to finance transactions, for example?
Yeah, I think it's maybe important to distinguish between platform and bolt-on transactions here. So on the platform side, I think I can't speak for other markets, but in the UK, credit markets are tight. Most debt providers that kind of I speak to are pretty nervous when it comes to lending on new leverage transactions, and obviously, as Podrick says, that feeds through into valuations. If private equity funds can't get, we've lived through a period of very attractive kind of low interest, covenant light debt availability. That isn't the case at the moment, and clearly that has an impact on valuations, and just generally, appetite to get deals done from sponsors, in just normal leverage buyout transactions. Obviously, there are parts of the market, so we typically wouldn't use leverage on day one of a transaction, so somewhat kind of insulated from that. But I think, I don't know what the number is, but say 80% of private equity transactions rely on leverage, and obviously markets are tight. In terms of corporate or lending for M&A, for PE-backed trade or just trade acquirers, I think and this goes to both M&A and just, debt markets more broadly. I think what we've seen is, the attitude towards existing borrowers has been, pretty favourable. Actually, people appreciate, or lenders appreciate, that we're going through, an unprecedented economic shock, and generally taking the view that, they're going to work with borrowers to find something that works for everyone. And actually, we've seen, a number of situations where incumbent banks are willing to be, I'm not sure aggressive is the right word necessarily, but very supportive of their portfolio companies pursuing acquisitions that they see as being beneficial to the long-term stability and trajectory of their portfolio company. So yeah, I think there's definitely a distinction to be made between sponsor-led deals and corporate deals. But yeah, debt markets are definitely tight.
Okay, and just elaborating a bit further, please, on your firm Hanover's ability to invest or acquire. I mean, have you particularly been affected in any unique ways?
Yeah, I think, for our strategy specifically, it's actually quite an attractive market environment. So we don't use debt, which I've said before, which is obviously point one, which just means you can be more competitive against people that are used to doing purely leveraged transactions. I think the more important point really is that our strategy is built around, I guess, complex deal situations. So we want to invest into situations where we feel there is some specific angle or means of us unlocking returns that aren't available to typical investors. So we're very operationally involved in our portfolio companies. We run a very concentrated strategy. And when I say operationally involved, it's not a kind of, just a non-exec seat on the board. It's, it's true, operational involvement in the portfolio company. And we're typically looking to invest in, fundamentally solid businesses with, some kind of driver of long-term value, which is being underutilized. And, that might be temporary market shocks. That might be poor, communication to listed markets about their kind of value proposition. Might be under management. There's kind of specific theses, I guess, that we're looking to unlock throughout our whole period, which means complex situations like, well, I guess if you juxtapose it to a normal PE fund, so a normal PE fund would be looking to invest in businesses growing at 10% plus organically, 20% plus EBITDA margins, 8% plus cash conversion, 70% plus recurring revenue. And clearly not everyone looks at that, but those are the deals that typically attract the highest valuations that most funds would be looking at. And I guess what we're kind of looking for is situations where there's a specific opportunity for us to bring our experience to bear, or some kind of angle that we feel that we uniquely positioned to unlock. So I guess it's somewhat insulated from what's going on in the market right now, or could even be positive for us given low valuation. Okay.
No, thanks so much for your perspective. Next question is for our resident Asian expert, Padriag, in Hong Kong. There's recently been quite a bit of news in the press around policy regarding Chinese acquirers acquiring companies in North America and Europe. Would you be able to provide your thoughts, please, about this and what that means for North American and European vendors who may actually be thinking of exiting to Chinese buyers?
Well, if you look at, I guess there is two sides of that coin. So maybe if we look at it from the Chinese perspective first. In 2016, China introduced a policy which really gave a big push towards outbound investment, but it was strategic outbound investment. It was looking for the higher end assets in the value chain, maybe around technology, to a certain extent, of course, still around resources, and also around branded goods and so forth. So things at the higher end of the value chain. Now, if the mission is to try and acquire those assets through Chinese entities, well, then what markets are you going to? It's going to make sense that you're going to look to the North American market, and you're going to look to the EU, and that has certainly happened. I think where the complications might arise is that if you were to look in the last 2 years in particular, there's been a strain in respect of trade relations between the US and China, and that's fed into difficulties around getting approvals and clearances through in respect of particular kinds of transactions, largely for national security interests and largely understandable, but nonetheless complications in terms of getting a deal across the line. And that had an impact in 2019, which was the lowest year in respect of deal size and deal volume into the US market. But nonetheless, the basic policy and the basic strategy was there. The Chinese government did moderate the initial policy from 2016 because there was quite a big fanfare and a big rush of capital outside of China when the policy was initially introduced. But in 2018, they put more of a process around that, so there was a bit more governance and restraint in respect of the types of investments that were approved and the kind of capital approvals that were given, and also the oversight in respect of investments that have been given. I think it would be unfair to say that it would be, you know, that the target is exclusively towards or primarily towards North America and the EU. One of the flagship investment mandates of the mainland Chinese government is the Belton Road Initiative, which is really about opening up collaboration between Chinese companies and businesses within Asia and spreading from Asia into Eurasia and into the fringes of Europe in terms of Eastern Europe and that. And that's really just a way of, it's a very strategic way of diversifying the basket of countries that you're exposed to in terms of trading partners, and also giving yourself the opportunity to acquire different kinds of assets and bring them back to the Chinese market and according to what are the priorities there.
Okay, and just actually a follow-up question, because as our firm, we do, as just about everyone on this panel, quite a bit of work in Asia. Is the image of Belton Road, has that been tarnished at all by COVID?
I wouldn't say that it's been tarnished by COVID. I actually don't think that there is too much of an impact from COVID specifically. I think what happened with the first round of Belton Road investments is that there was a rush of capital into projects that were maybe not as good as they should have been. And that takes a couple of years to, you know, feed through and for people to realize that essentially money has been wasted. So there's been more of a tarnish arising from that first round of investment rather than specifically in the last, 6 months in relation to COVID issues.
Okay, thanks, Padriag. Next question for Raj. Currently, we've been seeing a significant hike in terms of alternative debt funds and activity from private debt lenders during the COVID crisis. And I'm wondering if you're seeing the same thing in your practice, and in particular, if there's if there is a change, from what you've seen in the past. I mean, if you could discuss what that might be and your thoughts as to why.
Sure, Drew. I mean, look, I think in a landscape where the impact of the outbreak is not fully understood and is evolving, you know, valuations are evolving, markets are volatile, buyers are kind of reevaluating the cost of capital in a struggling market, and certainly considering alternative finance solutions. You know, so I would certainly echo your observation that alternative sources of capital are being explored given some of the challenges of securing traditional sources. Specifically, what we're seeing on the capital markets is, an increasing issuers who are securing and pursuing discussions with various alternative investment firms which are involved in kind of like PIPE facilities, so public-private, public investment in public securities, almost like equity lines of credit, which aren't necessarily sometimes the most efficient mechanism for raising capital, but they're using them for specific use of proceeds. So, to bridge and acquisition finance, working capital for very specific corporate development initiatives, certain kinds of regulatory approval, go-to-market strategies. in terms of, I mentioned earlier in the capital markets, we are seeing the traditional equity markets being available for sectors that are in fashion or momentum at this current time. So mining and life sciences being the two principal examples. I think, in the backdrop, what's happening is, companies are facing a decline in revenue, and their kind of competing priorities probably at a board level in terms of determining what they're going to use the available cash for, and whether they use it for M&A or whether they keep it organically. Because if there's this kind of shift in liquidity, I think it's to pick up on a point that Padriag had mentioned earlier, it's having an impact on a number of items. And one of them is, you have management who are now looking at existing credit facilities and trying to assess whether they're, on-site existing covenants and what the impact may be or is as a result of COVID-19. Do they need to go to their lenders and get waivers or renegotiate covenants in the context of what is actually now going to be achievable given this new paradigm that we're in? And I think the other thing they're doing is they're looking at existing sources of capital and trying to figure out how much headroom they have, right? How much undrawn borrowing capacity do they have, given that the challenge is that with the impact of COVID, your prior forecast scenarios are not likely to be, relevant and need to be readjusted. So that obviously has an impact on top line and cash flows for companies.
Okay, well, great. Thank you. Thank you very much, Raj. And Dan, the next question's for you. Really transitioning over to the logistics of completing a transaction, getting that proverbial ball across the line. How are buyers getting comfortable around due diligence in the absence of face-to-face meetings and the ability to form those relationships with sellers?
It's not easy. I think purely from a diligence perspective, I think 80% of your DD is it's not massively affected. So most of your DD is kind of is desktop based and is based on information uploaded into the data room and coordinating with external providers and whatnot. And so the actual mechanics of conducting due diligence is not necessarily that different. Clearly, from a DD perspective, the big change is not having kind of ready access to management and being able to meet management face to face, and that forms a pretty important part of most buyers' views on the ability of management. And I think actually, perhaps it's certainly making me second guess this, and maybe other people, perhaps it's making people second guess their own ability to actually ascertain the quality of management from a management meeting. And it's not actually clear that that's a good signal of management quality. I think that's one thing. But yeah, from a DD perspective, certainly, your lack of ability to spend time with management is impactful. Most of the deals that I've been looking at have been, 100% actually software. So, you don't have the same issue with site visits. You don't have the same issue around, basically fixed assets. And so, the actual in-person due diligence is perhaps less of an issue. But I think the main point is in terms of, building a relationship with sellers, I think it's extremely difficult. So I think from a purely personal perspective, most of the transactions that I've been working on have been processes from a pre-COVID world where you have a relationship there. So perhaps it doesn't necessarily make as big of an impact as it otherwise might have. But trying to build a relationship with a management team or a seller, virtually, I think it's extremely challenging. And it might be that isn't so much of an issue in the kind of early stages of transaction, but it's towards the latter end of the deal when inevitably you have the fraught discussions and some difficult decisions have to be made and some compromises have to be felt by both parties, and that's when the trust kind of plays a really important role. And I certainly feel that kind of in-person, face-to-face meetings is without exception the best way of building that trust. And I think it's not a straightforward thing to do, not a straightforward thing to do remotely. In terms of, I guess, not moving away maybe from the pure in-person thing, what has this situation changed from a diligence perspective? I think all of us are using metrics that we never thought we'd have to use before. So, I certainly have never seen situations where, a key metric that you're looking at. And to be honest, I'm not sure we've necessarily been doing this too much, but I think, the popular metric going around the markets at the moment is days of liquidity with zero revenue. So how many days can this company survive if revenue falls to zero without, needing to raise more liquidity? Which is just a metric that I don't think anyone's had to use before. The other thing I think that we're certainly spending a lot of time kind of looking at, clearly, you're spending a lot of time thinking about your downside cases and, how your capital is protected in different scenarios. And we're spending a lot of time thinking about the kind of, the software transaction churn, and, in different churns, we're realistically mapping out scenarios where, what if 50% of customers churn, 25% of customers churn, and these are businesses that historically have had, single-digit churn rates. And that's not to say you make a, a valuation decision based on that analysis, but, you have to perform that analysis so you can see, what your kind of investment looks like in those situations. So, yeah, I think diligence-wise, it's kind of the management diligence is the key thing that's changed, and just, the new metrics that you have to think about and you perhaps haven't thought about using before.
Yeah, and just a follow-up question, putting yourself on the other side of the table, the seller side, what in your view can sellers do to better position themselves for an exit given these challenges you've mentioned?
I think it's difficult, to be honest. I think it is super important to be, and this is perhaps more of a thing for an investment banker or an advisor, as much as it is for a seller, it's just being super realistic and being, cognizant of the fact that whilst long-term trajectories of businesses might not necessarily change because of the sheer range of outcomes that you have to think about, that clearly has to have an impact on valuation, just discounting the wider variation in potential outcomes than you were before. And I think, that applies from a buyer perspective too. It's kind of, as a buyer, sometimes you're banging your head against the wall and saying, come on guys, we're in the midst of a global pandemic. Clearly, everyone's view of valuation has to change, but, it's important for buyers to recognize that, the seller doesn't have to sell just because your valuation has changed. A lot of people have a kind of reserve price in their head of, what is fair compensation for a life's work. And, that doesn't necessarily change just based on economic conditions. I guess pragmatic steps a seller can take is, it depends what, I guess it depends what your goal is. If your goal is to sign the deal as agreed, then it's kind of difficult. I guess if your goal is to sign a deal that works for all parties, then I think just being open to suggestions. And I think one maybe slight distinction I'd make on the point Padriag made earlier is, the price is typically the first lever that, as a buyer you think about, rightly or wrongly, it just is. But actually, when you kind of sit back and you think, what does a price mean? A price is important to protect your downside, and it's important to determine your eventual return. And there are other mechanisms to do that. So sometimes, the price is set in stone, and you have to think about deal structure as a way to achieve the same goal essentially as impacting the price, but perhaps suiting different people's goals better. So, I guess the most classic scenario to put it into a concrete example would be a situation you quite often get it in a management buyout where, the incumbent management team want to maximize their upside and the private equity fund want to minimize their downside whilst realizing an acceptable rate of return. And so you might introduce some kind of deal structure that has some kind of ranking for the private equity fund and then some kind of ratchet type mechanism for the seller. But I think just generally being kind of open-minded is important, although I recognize that it's kind of self-serving for me to say that. So take it with a pinch of salt.
Okay, well, thanks very much, Dan. And I'll just take this moment again to reiterate to all the participants, attendees of the webinar, it is possible to send questions. We've already received some interesting ones, but it's not too late to send questions through, and we can, time permitting, pose them to our group of panelists. So moving on to the next, I actually have a few, I'll call them open forum questions. They're not targeted toward anyone in particular of you three, but just feel free to jump in and answer if you like. The first is, in terms of, I'd be curious, and again, this is of a personal nature because I'm the one at IJW that's heading up our evaluation practice globally. But what trends are you seeing in terms of valuations? Have valuations been significantly impacted, in particular for private companies, or are they thus far resilient?
Sorry, Raj, go ahead.
Go ahead, Raj.
So I think in the current environment, there's there's a lot of volatility. So there's a lot more negotiation and discussions around the seller's valuation. I think buyers are, as I mentioned, going to be much more diligent in trying to evaluate the projections associated with the seller's business on a pro forma basis. And I think what the impact of that could be and will be is on how you structure the purchase price payments. And so I think, there's going to be more discussions about creative ways of contingent purchase price mechanics, maybe through earnouts or otherwise, because ultimately these financial projections are going to have an impact on cash flow, given the extended impact that COVID-19's having.
Okay, and Podrick, you were mentioning something as well?
Yeah, maybe just to build on that point. I mean, if you look at the problem with valuations at the moment is the common valuation metrics that you might use don't really apply in the current circumstance. If you're taking, say, discounted cash flow, well, that's based on historical performance projected out. Now, would you take your financial performance of the past 2, 3, 4, or however many years and say that that's a reliable basis for what you're going to do for the foreseeable? So the basis on which you might use that as a justification for a particular valuation begins to have, shifting sands beneath it. And if you're to use comparisons, well, what peers would you point to and a reliable basis to say they're valued at this right now, therefore I should be valued at this? So, a lot of the underpinnings to valuations are just so uncertain, and therefore it's very difficult to be able to put a fixed number on what the value of a business is. But I suspect that I'm speaking to one of the experts there yourself, Drew. You might have a few views to share.
Yeah. Actually, I certainly do, but I'll, just in the interest of keeping, because questions are really rolling in, I'll keep them to myself or take them offline. But Dan, do you have any thoughts on your observed trends in valuation?
I think it's kind of, it's unavoidable. Valuations have definitely come down. I think in terms of, to Padraig's point, how do you kind of think through valuation in this scenario? I think what it definitely shines a light on, at least for me, is the fact that, the traditional valuation techniques or, I guess, methods people use to come up with valuation offhand, so your EV over EBITDA multiple and your comparative analysis, is making you realise that those things are just shortcuts. They're not actually the end goal. They're something you use to sense check, or at least historically have been something you use to sense check a valuation, and actually is, you're buying a set of future cash flows, and you have to think about what is the net present values of those future cash flows, which sounds kind of super theoretical, but EV over EBITDA assumes some level of stability in earnings, and clearly we're going for a period where that isn't the case. Then you have to think through a bit more pragmatically, I think, and a little bit more, I guess, bottom up and granular. What is the true, what do I think is the, the future value of this company, including, some very wide range of potential outcomes in the kind of immediate or near term or next 1 or 2 years of plan. And what is an appropriate discount to apply to my kind of thought on value that builds in downside protection? The only mitigant for uncertainty is margin of safety. It's kind of knowing that your price acknowledges the wide range of outcomes that might end up kind of eventualizing. EV over EBITDA and kind of peer analysis kind of misses that granularity. So, you know, you can't just say, right, my, you know, forward looking, you know, my historic EBITDA number is great. And, you know, this would be a 10 times business off that historic number. But, you know, my future EBITDA number is going to be 20% of that. So I'm going to pay 10 times that number, because then you don't have dip, obviously. You know, why would a seller agree to such a punitive valuation? You know, you have to think through some kind of balance, I guess, and it is a DCF, some kind of balance of, you know, what is the long-term trajectory of this business? How much is that impacted by current performance? You know, some businesses will experience a permanent, you know, impairment of future performance. Some businesses won't, it will rebound quickly. And, you know, you have to make a judgment call on which of those two things, or where on the spectrum the company you're looking at lies. And then you have to apply some, you know, I think the prudent investor has to apply some kind of discount to that to reflect some margin of safety and uncertainty.
Okay, thank you, Dan. Actually, I have a question. Again, thanks. They're really flooding in. One's from Eris, and again, open question to whoever would like to tackle it. Have you seen any differences in M&A deal cycles by deal size? For example, you know, segmenting it, are deals below $50 million moving faster or differently than deals above 50 million?
Maybe I'll start. So I think I'm not seeing a particular distinction in between deal size, but I think there is certainly an impetus on sellers who are trying to mitigate against potential delays and want to move forward as quickly as possible. I think one of the practical challenges from a timing perspective that have come up on deals, in addition to securing financing, is how do you deal with that period between signing and closing, and how do you, you know, as most of us know, there's generally covenants that the sellers give about this interim period of how they're going to run their business in the ordinary course. And so because of the volatile nature of the markets, because of COVID-19, sellers are trying to compress that time period and close rapidly, so they could kind of minimize the constraints that they are imposed on their business during this kind of contractual time period. So, you know, certainly from my perspective, we're seeing some of that on the seller side, and that's agnostic to deal size.
Okay, thanks, Raj. Anyone else have any comments?
Yeah, one other thought just in respect of that period between signing and closing, maybe not to the same point, is other issues that can arise is the difficulties in getting, you know, conditions across the line if there are conditions to closing, particularly if it's a third-party approval or regulatory approval. That's really quite delayed. And you know, sometimes you'll have long stop dates within your documents that seemed reasonable at the time, but now look as if they're almost fanciful. And we have had some deals where there have been discussions about material adverse changes, MAC clauses, and whether or not they can be invoked. In general, they haven't, but it is one of those things that people have talked about, and maybe just as a way of teasing out different aspects or different issues that they want to nuance and have a bit of a discussion about.
Yeah, I think you're right, Padre. I think that's a very good point. I think new buyers to any purchase agreement in the current climate will want to make sure those MAC clauses are, you know, they can address as, you know, as wide as possible a situation relating to shifts in, you know, economic or the market landscape.
Okay, thanks. So another question is quite good. This is from Linnell, and who's saying he's curious if anyone would be able to speak to what industries are thriving and selling at high multiples during this COVID environment versus what industries are struggling to get deals across the table in such environment.
I think from my perspective, it would be, I don't think I have anything particularly original to add. It would be exactly the sectors that you kind of expect. So I think the slight difficulty we have with the situation happening right now is that what it's actually done is increased, I guess, quality trends that you were seeing pre-COVID. So you know, if there's this, I guess, divergence going on between, I guess, more technology focused software, you know, more resilient revenue model type companies and more buyer interest in those types of companies. It just so happens that, you know, I guess shelter in place impacts those companies less typically than it does for, you know, for the other end of the market where I guess buyer interest is probably diminishing, which I would, you know, say retail, restaurants, anything basically, I guess high street traffic focus. And I think people are taking a pretty dim view on sectors that were struggling pre-COVID, and it just happens that those sectors correlate quite highly with the sectors that are also struggling during COVID. I think maybe you've seen a little bit of flight to quality in private markets. So I don't think that many new deals are getting done anywhere, but you know, those deals that haven't fallen over as a result of COVID, I suspect fall over at a less, you know, a lower rate in sectors like software, tech-enabled business services, things where you have very predictable revenue streams and ideally predictable revenue streams offering some kind of service that, you know, your customers can't live without. That's not necessarily a kind of sector-focused thing. I guess it's more, you know, what is your value proposition to customers? But yeah, I kind of struggle to say anything other than it's kind of on the lines you expect. So, you know, consumer, I guess non-discretionary consumer, discretionary consumer businesses struggling, software and things with high levels of, you know, recurring revenues struggling less.
Okay, thanks, Dan. Anyone else?
Maybe I'll add, Drew, as I was mentioning earlier, we're seeing an increased interest in mining M&A, in particular in the gold sector, and that may be a function of investors looking for a flight to safety and stability through gold, and a more challenging environment in the equity capital markets for traditional exploration and producing companies to secure capital, and therefore, given that kind of financial reality, that may act as an impetus for companies to consolidate and merge. So I think we'll see certainly some more M&A in the mining sector, particularly gold. And I think given the challenges, that'll likely evolve.
Okay, thanks, Raj. And actually, an interesting follow-up from Lionel. How, again, open question. How quickly do you see a return to normal deal flow and transaction level, or will we ever get back to normal?
I guess at this stage, if you're to look at the public health situation, because there are so many moving parts to it, and because it is a genuinely global issue, it is one of those questions where you're not sure whether, as a matter of fact, you will arrive at what was previously normal, or at what time that you will do. What I think you can do, for instance, here in Asia, we're beginning to see the first seeds of an opening up of economies and a resumption of normal activity. And you do get a sense that there's a pent-up desire almost to create that, you know, economic drive and economic activity that will then feed through the system. But you know that it's fragile. So whether you will find something that is long-lasting and enduring, it's a bit up and in the air at the moment. But I think the sentiment will return maybe faster than the actual volumes of deal activity.
Okay, thank you, Podrick. Anyone else?
I guess it depends what you mean by normal. You know, was 2019 and the run up to it, you know, a normal time for transactions? Who can say? I guess if the question is, when do we think we'll, you know, reach the prior peak? I think it's near impossible to say. So, you know, if I had to kind of predict, I would be more on the bearish end of the spectrum, and, you know, think that it might take, you know, a significant amount of time, you know, years rather than quarters for M&A. I mean, obviously this might be proven completely wrong, but for M&A to get back to the level that we saw in, you know, in the last couple of years.
Okay, thanks, Dan. And next question from Samuel, seeking to solicit a bit of professional advice. If if your current deal or a current deal has failed due to COVID-19, what do you perceive as being the implications on marketing that same deal in the future? Do you think it will be more difficult, or will potential investors or buyers be understanding?
Maybe I'll start. I think in part, Drew, it's going to be a function of were there any additional factors which were attributed to that deal being terminated? And so, is it specific to COVID, or are there other factors which COVID has a corresponding impact on the business model of the company in question? And I think that'll be the more kind of fundamental question, which sellers have to address in an M&A environment going forward. And I think if it's purely because there's market volatility and COVID doesn't necessarily have a direct impact on the business model of the business in question, I think, hopefully maybe that doesn't then have a negative impact on the company going forward when they return to market. Although I would say, I suspect, and this is more into your area of expertise, notwithstanding that valuation would nonetheless be impacted just given the current environment we're in.
Okay, thank you, Raj. And I'm actually saying, just in the interest of time, we only have 3 minutes left already. It has passed quickly, been incredibly informative. I'd like to ask each of our three panelists to give us their final thoughts, share final thoughts, perspectives, whatever they'd like to say in 60-second segments. So, Padriag, I'll put you up first.
Well, let me think. I would like to end on a note of positivity. If you look in terms of any value investor will say there's nothing like a good downturn in order to either start a new business or to acquire other businesses at a better valuation. So there is an opportunity there, in spite of all the complications and all the difficulties that we've explained. There is an opportunity there to maintain, an interest in acquiring and growing by acquiring. And I was listening to an interview with Tom Hanks, who really should be the leader of the free world. And one of the things that he kept on saying was, this too shall pass. So this too shall pass, and when it does, there will be a new normal, and we'll all be looking forward to getting back to it.
Okay, thank you, Padriag, who incidentally is leading us not in the first response to this final segment of questions, but he's also earliest in terms of time zone. So moving to the next time zone will be Dan.
Yeah, I think I'd try and echo the positive sentiment there. So I think, if you look back through time, one thing that's, very clear is that whatever economic difficulty has been kind of thrown at the world, we've always managed to find a way through. Clearly that comes with difficulty, clearly it comes with pain, but it's not just the kind of the hopeful person that thinks we're going to get through this. The pragmatist and the realist takes that view too, because it's always happened in the past, and it absolutely is going to happen again. And I think purely in terms of your kind of I guess an outlook for buyers and sellers and people just involved in an M&A more broadly, I think it's an opportunity for everyone to, I guess, think more deeply about the deals that you're doing, and I guess your downside scenarios. You're now living through them, and it makes you think more deeply about what those things mean. At least for me, this is the first, show my age here, but the first downturn that I've worked through, and it makes it all so much more real, and it makes you realize why you have to think so deeply about a bunch of these different things, because it's a fact of life. Downturns happen, businesses get tested, and as an investor you need to position your capital to be able to withstand that. But what's important to remember at times like this is where typically the best returns are generated, and as long as you keep your head and you can invest confidently, knowing that we're going to get through this in the end.
Okay, thank you, Dan. And Raj, your final thoughts, please.
Yeah, I would echo both Dan and Padraig's comments, this will pass. It's clear in the short term, not business as usual for M&A deals. We're operating in a new environment, and hopefully kind of short-term considerations are going to evolve to more longer-term and fundamental shifts kind of in terms of deal strategy, valuation, liquidity. I think that this paradigm has created some new business opportunities, and there's going to be some businesses that are going to emerge from this cycle. And those that are sitting on capital, to echo Dan's points, are going to be opportunistic and look at opportunities for acquisition. So I think, you know, we just have to be safe, and hopefully this will pass.
Okay, thank you. And that concludes our seminar. I hope you all listeners found it extremely informative and learned quite a bit. And I'd very much like to sincerely thank our panelists, Dan Skyte, Rajeev Dewan, and Padraig Walsh. This is Drew Dorweiler at IJW & Co. in Montreal. Thanking you once again for listening and wishing everyone health and safety.
Thanks, guys.
Thank you.
Guys.
Thank you all.